Welcome to The Explainer. Now, we all think we know the story of what caused the 2008 financial crisis. But today, we're going to dig into a really powerful theory that points to something different, a hidden, predictable cycle. One that suggests the crash wasn't random at all, but kinda inevitable.
All right, let's just dive right in. You've seen the movies, you've read the headlines. The story of the crisis usually gets boiled down to two very human, very dramatic things. Just pure, unadulterated greed, and then, of course, widespread panic. And you know, these explanations, they make for a great story, right? You've got your villains, you've got your victims. But the problem is, they also treat the crisis like it was some unpredictable force of nature, a sudden emotional storm that nobody could possibly have seen coming. But what if that's just not the whole picture? Let's explore a different idea, one that suggests the boom and the bust weren't two separate events at all, but actually two inevitable sides of the exact same coin, a powerful, hidden engine called the leverage cycle.
So, to really wrap our heads around this cycle, first we've got to get a handle on the thing that powers it, a concept called leverage.
So, in the simplest terms, leverage is like a financial superpower. It's using a little bit of your own money, plus a whole lot of borrowed money, to control a much, much larger asset. In this case, your $20 lets you buy a $100 house. You're leveraged 5 to 1.
And here is the absolute key to this whole theory. It's not just optimism, or what they call irrational exuberance, that drives prices up. No, it's the actual mechanical ability for people to borrow more money. When leverage goes up, prices go up with it. It's that direct.
Okay, so how does it start? Well, the cycle begins really quietly. Think back to the early 2000s, a period some people called the Great Moderation. Things just felt stable, safe. And this feeling of calm convinces lenders there's less risk out there, so they start offering more generous loans, smaller down payments. And when that happens, suddenly, way more people can afford to buy a house. And the people who could already buy one can now afford a bigger one. All this new buying power floods the market and, well, it pushes prices higher and higher.
It all sounds pretty great on the way up, doesn't it? So if high leverage is the fuel for this massive boom, what is it that turns that boom into such a devastating bust?
Well, as leverage and prices keep climbing, the total amount of debt in the system just absolutely skyrockets. Think about it. You're borrowing more money to buy a more expensive thing, so debt gets this double boost. The whole economy becomes incredibly fragile, like it's balanced on a knife's edge, totally vulnerable to even the smallest shock.
And then the shock hits. The theory calls it scary bad news. All of a sudden, lenders get nervous and they slam on the brakes. They tighten their standards, demanding much bigger down payments. This sets off a massive chain reaction. Borrowers who were counting on getting new loans to pay off their old ones suddenly can't. They're forced to sell their assets to get cash. And this forced selling just floods the market, which causes prices to crash, which then triggers even more forced selling. It's just a brutal downward spiral.
And here you can see the whole thing laid out visually. Now, don't worry about reading every single word on the slide. The key takeaway is seeing how each phase just logically leads right into the next. It all starts with that period of calm, which leads to easy borrowing and high prices. That creates a fragile, high-debt economy. Then a shock hits, borrowing dries up, and boom, you get the crash. It's a complete interconnected system.
And this brings us to a really crucial distinction. The most important phrase here isn't panic, it's margin call. See, people weren't selling just because they were scared. They were selling because their lenders were forcing them to. It was a mechanical process, not just some wave of emotion sweeping through the market.
Okay, so that's the theory. It sounds compelling, right? But does it actually hold up? Does it match what really happened back in 2008? Let's take a look at the evidence.
All right, now this chart is basically the smoking gun for the entire theory. So let's just take a second to break it down. The gray line is tracking home prices. The black line shows the average down payment that was required, but, and this is key, notice it's on a reversed scale. So as that black line goes up, it actually means down payments were getting smaller. Just look at how closely they mirror each other. As down payments dropped, meaning leverage was going through the roof, home prices shot up right alongside them. And the second lenders got spooked and demanded bigger down payments again, the price bubble just completely burst. I mean, it is a near perfect correlation. And the amount of leverage we're talking about, it reached absolutely incredible heights. At the peak, an average down payment of just 2.7% meant some people were leveraged 37 to 1. 37 to 1.
That's like putting down less than $3,000 to control a $100,000 asset. The whole system was stretched to its absolute breaking point.
So the whole system was primed. It was ready to fail. All it needed was that one little piece of scary bad news to light the fuse and set the whole thing off. So, what was it?
It was this chart right here. For years, the rate at which people defaulted on these risky mortgages followed a really predictable pattern. You can see that in the lower lines. But then, look at the top lines. Those represent loans made in 2005 and 2006. They just blew right past that historical ceiling. Now, even though the total numbers were still pretty small, this was the scary bad news. It was a signal to lenders that their models were broken and that the risk of losing money was suddenly way, way higher than they ever thought. And that was the spark.
So if this cycle really is predictable, if it's not just some random emotional event, does that mean we can actually do something about it? Could we stop it from happening all over again? Well, the theory suggests that regulators need a totally new dashboard. Instead of just obsessing over interest rates, they should be monitoring what's called the credit surface. And what that really means is tracking all the terms of a loan, down payments, credit scores, the whole shebang. On this chart, that lower, flatter curve represents the easy money days before the crisis, when pretty much anyone could get a loan. The steep upper curve, that's the tight credit world that came after. The goal for regulators is to watch this entire landscape of lending, not just a single number.
And this opens up a whole new toolkit for policymakers. I mean, think about it. You can't regulate greed or panic, but you can regulate leverage. During a boom, you can maybe set limits on things like loan-to-value ratios to keep the system from overheating. And after a crash, the theory suggests that things like targeted debt forgiveness might be what's needed to break the cycle and actually get the economy moving again. So here's the crucial takeaway. By shifting our focus away from unpredictable human emotions and onto the predictable mechanics of lending, we might just have a fighting chance to build a more stable financial future. The theory of the leverage cycle gives us a new map. The question is, will we have the foresight to actually use it?